Well, good morning. Welcome to Everhart Advisors University. My name is Max Rosenthal. I help lead our education team, and I also co-host our podcast here at Everhart. And we cover different popular personal finance books. One of them that we covered was called The Psychology of Money by Morgan Housel, and that really led to today's presentation. Phenomenal book, highly recommend it. It's you're going to see it quoted a lot in today's presentation. And I apologize. I used I'm going to be reading a lot of text today because there was just so many good quotes from that book and then from a few others that we covered. But one of my favorite subjects is to talk about the psychology of money. I hope you feel the same after today's presentation. And we'll start with this quote from Morgan Housel himself. Few people make financial decisions purely with a spreadsheet. They make them at the dinner table or in a company meeting, places where personal history, your own unique view of the world, ego, pride, marketing, and odd incentives are scrambled together into a narrative that works for you. And it kind of begs the question, if investing were only about intelligence, why do highly educated people still make terrible financial decisions? So if it was just all about intelligence, then you would expect that every smart person would have a lot more money than people that maybe are less intelligent. Well, let's just use a case study, and again, this is taken right from the Psychology of Money book. We have the janitor versus the Harvard educated executive, and I think you can put two and two together as to whose house is whose. On the left, we have Ronald Reed's home in Vermont in 1960. And on the right, we have Richard Fuscone's home in 2010. Ronald Reed was a janitor at J.C. Penney's for, I think, 17 years. And I believe he worked fixing cars at like a gas station for 25 years. Whereas Richard Fuscone was an executive on Wall Street for Merrill Lynch. In the year 2014, Ronald Reed famously donated $6 million to a local hospital and library, and then another 2 million to his stepkids upon his death in 2014. So he was featured in the Wall Street Journal for being, a janitor that passed away with an $8 million estate. In that same year, and in that same publication, the Wall Street Journal, Richard Fuscone made headlines for his mansion going into foreclosure. And eventually, in that year, 2014, it sold for 75% less than the insurance value of the home. So, just kind of making a drastic point here that your education level and your intelligence related to finance, it doesn't always result in the best money outcomes. So, finance is not like physics, which is guided by laws. It's really guided by behaviors or arguably by psychology. So to grasp why Richard Fuscone buried himself in debt, buying and expanding his mansion, you don't need to study interest rates or economic forecasts, two subjects he would have been very knowledgeable in. You need to study the history of human nature. And in Richard's case, probably the study of greed. So doing well with money has little to do with how smart you are and a lot to do with how you behave. That's the starting point for today's presentation. And beyond that, the bolded line here is that behavior is hard to teach, even to really smart people. I talk to thousands of people every year one-on-one about their money, and that is just so true. It is just really hard to convince someone to change their behavior. So my hope is that you listen to this presentation with an open mind and really soak in the ideas that are presented and the data points with just a bit of humility. Because if you're able to digest these things, it can really influence and help your financial decision making. So we'll start with the brain. And really this is just taking a deeper dive as to why even smart people don't always make the best investment decisions. The odds are stacked against us. So I am not qualified to talk about the brain. the anatomy of the brain, but from what I've read from multiple books and to the little extent I studied the brain in high school and maybe some in college, these three pieces of the brain are really important to understand when it comes to money decisions. So you have what's called the amygdala, and people often refer to that as the fear center. So that's kind of our fight or flight operation of the brain. Anytime that we feel threatened or scared, that piece of the brain is firing. Then you have the dopamine system. So anytime that you feel excited or feel pleasure, that piece of the brain is usually operating. And then you have the prefrontal cortex. So anytime that you are thinking deeply, using logic and reasoning, using probabilities or modeling out scenarios, things that, usually apply to your money decisions, you should be using the prefrontal cortex. That's the spot of the brain that's firing when you're thinking deeply. And psychologists from Israel, Daniel Kahneman, and I think it's Amos Tversky. I don't know how to say his name well, but they won a Nobel Prize in economics for what's displayed here in this graphic, System One and System Two thinking. So they wrote a book called Thinking Fast and Slow, and I like these images to help us better remember what's happening here. So our brain can kind of think in two different ways. You have the rabbit brain where it's operating on autopilot, it's your subconscious, and it's the way that we operate to conserve energy for things that require deeper level thinking. So by way of example, like when you go to the grocery store, at least if you're familiar with that grocery store, you're not thinking too deeply. You just go directly to the aisles where you know your products are and you grab the same products every week. That's a good example of system one operating. System two is where you're thinking through complex decisions and, modeling things out, looking at probabilities. So those are the two pieces of the brain that we can operate under. And I really just want everyone to be aware that that's reality. So when it comes to your money, be more like the tortoise, pause, breathe, take time, think slowly, and don't operate on your gut instinct. That's usually a formula for making poor decisions. And the study of what's called behavioral finance is a growing field in like the academic space. So if you look at like the curriculum for any university program that's studying personal finance, you're going to notice that they have classes geared at what's called behavioral finance, where they extrapolate and look at data and study these different behavioral biases. And it's really just victimhood to the system one thinking. So one of the behavioral biases, I'm just going to scratch the surface here, just list a couple. One of them is called loss aversion. So people feel the pain of losses much more intensely than the pleasure of equivalent gains. So Larry Bird is famous for saying, like, I hate to lose more than I like to win. And there was a book that we covered on our podcast that I thought it was just very in depth. I maybe wouldn't recommend reading the whole thing, but there's a lot of good data, and it highlighted that financial losses are processed in the same areas of the brain that respond to mortal danger. So just like when, a bear is approaching you in the woods, when you see your account down, the same piece of your brain is firing. So it might not be the best time to make a big take action with your financial plan. You might want to wait until things have calmed down to make and change anything with your financial plan. And when it comes to losses, if you're the type that looks at your portfolio balance often, the odds are stacked against you to make a good choice. So this is the last approximately 45 years of S&P 500 data. And we're looking at, I should have just blocked the gray bars and showed the red dots because that's what I want you to look at here. The red dot represents the biggest intra-year decline in any given year. So you can see like in 2026, the market dropped from peak to trough about 9% when the war started. And last year it dropped by 19% when the tariff announcements hit. And in COVID, it dropped 34%. In the financial crisis, it dropped 49 or 34%. In financial crisis, it dropped 49. And there's all sorts of data points, and there's usually a real life event that happened that caused the market to retract for a period of time, but it's never been permanent. And the average decline is about 14% in any given year for its largest drop in that year. So when it comes to loss aversion, you can bet that many people might see their account balance down, and because they feel the pain of that way worse than they feel the pleasure of their gains, people tend to make pretty poor choices whenever the market takes a big hit. Another behavioral bias is just the illusion of control. So we tend to overestimate our ability to influence certain outcomes. And when it comes to finances, there's a lot of things that we actually can control. And that's what we want people to devote their time and energy to, clarify your goals and eliminate costs, draw down any tax impact you can. Make sure you have like your long-term estate plan in order, beneficiaries. Make sure your allocations correctly for your goals, and you're thinking about your time horizon and not just what the market's doing today or what inflation could do or what the political changes are going to be or what news headlines will pop up. And you have no control of how your family is going to react. And so it's just important to identify these things so that you don't make decisions based off things you can't control. Another behavioral bias that I really like is, at least I like to highlight, is called recency bias. So we tend to place just too much importance, too much weight on recent events. And I grabbed some pretty unique data here. These are 10-year premiums of small caps versus large caps. So the 10-year result of the aggregate of the small cap index versus the aggregate of the large cap index. And you can see the last, call it, I don't know, 10 years or so, maybe a little less, large caps for their 10-year annualized return have beat small caps, but actually small caps are usually the ones in favor. And similarly, you have value stocks versus growth stocks. And it's really just the last, call it 15 years, where growth-oriented stocks have outperformed value stocks. And when I sit across the table from individuals, I tend to see in their portfolios, if they're doing it themselves, a huge bias towards those types of companies, the large growth-oriented companies. And thankfully, it's done quite well. But if you just pay attention to long-term data, the odds are stacked against them to keep that outperformance indefinitely. So we would want people to take this data into consideration. Another behavioral bias is called overconfidence. This is just kind of funny. We all overestimate our abilities on some things in life, sort of non-financial related. But if you ask anyone if they're like a good driver, most people are going to say yes. There's lots of studies done showing that like 75-80% of people believe that they're a good driver. And of course, only 50% can be above average. So we just have this human nature situation where we tend to be overconfident on certain things in life. Certainly there's places where we're maybe underconfident, but that's a lot less so than the overconfidence syndrome. And then the last behavioral bias I want to highlight is just hindsight bias. I see this play out a lot. People looking backwards and saying, well, I knew, that event was going to happen. And so we start to think that we have this capability to predict the future, and that's just not true. So a good case study is looking at a pretty famous predictor, Michael Burry. So if you watch the movie The Big Short or read the book, great movie and great book, so highly recommend. But he's pretty famous for predicting the housing market crash in 2008, in which he actually shorted the market. So he made a ton of money while everybody else lost a ton of money in that 2008, 2009 great financial crisis. So if you continue to look at his career, though, you're going to see just a number of doomsday predictions that just did not come true. So it's just really dangerous to bet against the market. And it's just really dangerous in general to make some big prediction on a specific thing. We just don't have the ability to accurately forecast the future consistently. We might get lucky here, every now and then, but largely it's not a good thing to do that when making a long-term financial plan. And the next section I want to cover is just identifying luck versus skill when it comes to investing, which kind of plays into that overconfidence behavioral bias. But Morgan Housel, he once asked Robert Shiller, who won a Nobel Prize in economics, what do you want to know about investing that we can't know? And Robert Shiller said the exact role of luck in successful outcomes. And Morgan says, I love that response because no one actually thinks that luck doesn't play a role in financial success. But since it's hard to quantify luck and rude to suggest people's success is owed to it, the default stance is just to implicitly ignore luck as a factor at all and attribute everyone's, outcomes to their skill. So a pretty good example that Morgan highlights in the book is these two very familiar names to any American, Cornelius Vanderbilt and John D. Rockefeller. They have tons of universities and statues and books written about them. And in The Psychology of Money, Morgan Housel quotes one of his business advisors leaned in to tell Vanderbilt that every transaction he agreed to broke the law. And Vanderbilt said, My God, John, you don't suppose you can run a railroad in accordance with the statutes of the state of New York, do you? And similarly, John D. Rockefeller, a judge once called his company no better than a common thief. And he says, What do I care about the law? Ain't I got the power? So if you were to look at their examples and see that they kind of flirted with the law and got by with it, if you applied that to your life, like that's just really dangerous. So obviously they had great outcomes in their financial picture, but is that attributed to luck or truly to skill? And so we just want to highlight, focus less on specific individuals in their case studies and more on broad patterns. It's probably not wise to take these two examples and say, I'm just going to go flirt with the law and try to cheat the system to have an advantage on everybody else. Probably not a good strategy there. And when it comes to investments, it's just really, really challenging to be skillful. So if you look at the top mutual fund investment funds, if you look at the top quartile over this 20-year period for any 5-year run, and then you track them for the next 5 years, they tend to fall outside of that top quartile. So the ability for these fund managers to stay in that top performing quartile it's really challenging. And these are groups of people that do it full time. They have a staff, they have a lot of resources and time on their hands that are devoted to picking the right funds. And historically, it's just really hard for these groups to stay at the top of their discipline. They tend to underperform the market over time, as evidenced by this chart. So this is looking at all of the active equity funds in the US and tracking the major categories. So large cap would be compared to the S&P 500, mid cap, small cap, and real estate. And this is at the end of 2025. So I look at this chart produced by Spiva. They produce it semi-annually, and it's just remarkable. So in any given year, there can be times where the active players beat the index. So, for example, 46% of the mid cap space, the index lost to the active investors. So, if you were an active investor in the mid cap space over the course of 2025, the odds were in your favor, actually, of beating the market. But when you look at long periods of time, for example, 20 years, it's nearly always 90% or above where people underperform the benchmark that they were trying to compete against. So it's just kind of case in point that very, very few people are very talented when it comes to investing for the long term. Like not everyone can be Warren Buffett. He is unique outlier in the field of people trying to, pick stocks and invest well with their money. It's no different than take, for example, like LeBron James. Not everybody, there's very few people that can be compared to LeBron James, yet so many investors think that they can step into the field and perform at that level. It takes crazy talent, insane discipline, a lot of focus, and years to become an expert at the craft to do this well. So historically, it's been better to just let the market work for you, own those index funds. And then the last piece I want to highlight before I get into what really works when it comes to behaving properly is just pointing out that wealth is invisible. So there was a book written about 30 years ago now called The Millionaire Next Door. It's a perennial bestseller, very, very good. And it just highlighted who are the real millionaires out there in America. And I just highlighted a couple points of who these people are. So the first one is they live below their means. Nearly three times as many households with investments of 1 million or more live in homes valued at $300,000 or less than those living at homes valued at 1 million or more. So just the things that we can see, people's homes, like that usually doesn't dictate if they are very wealthy or not. And additionally, people that are millionaires are usually saving 15% of their annual income before they pay for their lifestyle. So their lifestyle usually isn't matching what their actual income is. It's greatly under that, right? They're saving and investing as much money as they can. And a lot of them did not inherit any wealth. So they didn't come from some big rich family. They are self-made millionaires for the most part. And then they own just productive assets. So rather than necessarily owning the big home or the big fancy car, like they just own stocks. And I don't know about you, but I don't know how to walk around the block and look at someone and determine what kind of stock portfolio they have, right? It's invisible. So that's the challenging part with determining who it is that we should follow and who the real wealthy are is just the main parts of their financial lives are invisible. And just last two bullet points, most of them don't own or lease a luxury car, and then they devote a good amount of time to just planning their financial lives. There's a strong positive correlation between the time they put into planning out their long-term finances and the success of their outcome. So those are things that you can't see what people are doing behind closed doors, mapping out their financial journey. But this is a very thoroughly researched study on millionaires, and it's a wonderful book. Again, highly recommended if you're a reader, or you can listen to our podcast on it. So I'll close with what actually works, and I really want to start with risk. So when it comes to finances, people rightfully assume that investing their money in particular stocks is risky. Absolutely, totally agree with that. Every financial investment you make has some level of risk with it. There's no escaping it. But not investing is also risky. So there's truly just no escaping risk in general. Whether you invest or don't invest, both choices result in some level of risk. So to us, our definition of risk, which is really the main thing that people should be focusing on, is just not meeting your financial goal. So rather than worrying about the risk of the market movements or inflation risk or whatever it is you want to look at in the financial realm, we really want people to focus on the goal of not reaching their financial goal or reaching it. So if your goal is to build long-term wealth or to create income that will last throughout your retirement lifetime, then investing in something like stocks likely makes sense. So just to kind of quickly prove that point, since 1960, CPI, the Consumer Price Index, has gone up 11 times. So, like, if you just held $1 million in cash from 1960 to today, you've lost considerable value, right? The world is 11 times more expensive. So that same $1 million is not going to buy the same things today that it could in 1960. Whereas if you invested that $1 million, well, the first thing to note is that you would have been getting dividends along the way. So if you did something like the S&P 500, your dividend income, it would have gone up 40 times. So you would have essentially 4 times the purchasing power just from the dividend income that gets kicked out from that investment portfolio, let alone the principal value of the S&P 500, which went up 118 times. So that's 10x the value of inflation. If you combine, the dividends with the principal value, you have greatly increased your purchasing power if you invested your money over that lifetime compared to the cost of inflation. So just really, really important to understand that. And that all ties back to risk. We really want people that are aiming at any long-term financial goal to catch wind of how valuable it is to be invested in productive assets. And then just a few quotes from Morgan Housel that I kind of want to close on. He says, beware of taking financial cues from people playing a different game than you. And I just think that's really wise. So when it comes to your money, most people are asking questions, right? They either ask an advisor like myself or their dad or their best friend, and just be aware that everyone has different incentives and a different view of the world, and they might not match what you're trying to do. So just make sure they have your best interest in mind. Take for example, two kids that have just come out of college. One has considerable debt from, college loans, and the other had their parents completely pay for college and maybe even gave them a kickstart with some money to buy their first home. Well, if those two people went into the same field and got the same income, they should probably live very different lives, but they might not know that each other is living with very different net worths. And so it just can be challenging to take advice from the wrong people. So just ask a lot of questions and make sure people have your best interest in mind when taking financial advice. Another one that I loved is optimism. So Morgan says it's the best bet for most people because the world tends to get better for most people most of the time. There's some just incredible data out there that really shows the drumbeat of history is one of progress. And I don't want to undermine the hardship to life and the difficulties out there, but largely speaking, those that have a very pessimistic view, they don't tend to invest and they tend to, be just hard to deal with, and they don't go full into their careers and take risks. They're really sheltered, and that's just tends to not be a good formula for building wealth and doing well with your money. And then lastly, I love this: worship room for error. A gap between what could happen in the future and what you need to happen in the future in order to do well is what gives you endurance. And endurance is what makes compounding magic over time. So I think it's Warren Buffett or Charlie Munger. He says, don't interrupt compounding unnecessarily. If you do that, you strip it from its power. And to stay the course, you need to map out your finances in a way where there's some room for error. We just have no control of what the market's going to do or what inflation will look like. So when you're modeling things out, just give yourself some wiggle room. That will allow you to stick with the plan when the hardships do come, because they will come. And then I've quoted Morgan Housel a lot, but let me quote a few others. I love some of these quotes from some of these notable names. So the first is Benjamin Graham. He was Warren Buffett's mentor. So I'm trying to think of his famous book, and it's slipping my mind right now. But the quotes are: "The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave," which totally ties into the presentation we just walked through. "The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan, and a behavioral discipline that are likely to get you where you want to go. Phenomenal, phenomenal quotes. Peter Lynch, he's famous for greatly outperforming the market for a pretty lengthy period of time. He worked at Fidelity and he managed the Magellan Fund. You can look it up and see its performance. It's pretty remarkable. And he says far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And that ties hand in hand with just that the fear center of the brain, right? We just feel that impulse so strongly, and so many people try to anticipate these corrections, and that's just not been a good formula for success. He says the real key to making money in stocks is just to not get scared out of them. And then we'll close with the great Warren Buffett: a market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. The stock market is simply a device to transfer money from the impatient to the patient. So, tying all this into a bow, I developed this wonderful AI image of a tree. And I can think of no greater analogy when it comes to your personal finances than that of just a basic tree. You know, the process of a tree, it's the seed that gets planted in good soil, and then there's all these ingredients that make it work, but it's really messy, right? There's storms, there's sunshine, there's growth, and then there's, decay. The leaves rise and fall every season. And so it's not always the prettiest looking tree each specific little season, but over the course of time, it can turn into a deeply rooted, large, and beautiful tree. And I think it's Warren Buffett that said, someone today is sitting in the shade because many years ago someone planted a tree. And that's just perfect when it comes to your financial journey. The people that have the best outcomes are usually those that started early. They did those boring disciplines. They used the right ingredients of living below their means, getting diversified, creating room for error, having an emergency fund so that you can let the compounding work through the hard seasons. And they have long-term goals and they're acting on a plan. They're not whipsawing with their feelings. They're not falling into that system one type of thinking where they just fall into these behavioral biases. So hopefully this image sticks strictly in your mind every time you look at a tree going forward. I want you to think, that's what I am with my personal finances. So just a beautiful analogy, and it couldn't be better. Uh, if there's any time that you guys have questions, that's exactly what we exist to be there for. So here's our contact information. You guys are welcome to schedule a direct one-on-one with me. And I've referenced the podcast that myself and my colleague co-host. You can search us on Spotify or Apple Podcasts. We're covering a number of these books that I've highlighted today, and hour-long episodes. And yeah, it's a good place to just get more education. So I will pause here and stay on the line for any questions that have been posted. You guys can type them in the chat box, or I think there might even be like a specific Q&A section. Well, not seeing any questions come through. So for those that are still on here, thank you so much for listening. I believe, this was recorded, and the slides, both the recording and the slides, will be emailed to everyone that signed up. So you can look at this on your own time, or re-listen or share it with someone if you were thinking of someone that needs to hear some of this data. So again, thanks so much, and we'll see you next time.